She said. Joe Duran from United Capital's with us today. So is Ken Mahoney from Mahoney Asset Management. Kevin Caron from Stifel Private Client. Monica Meda from Seventh Capital. And our own Rick Santelli joining us as well today. Joe Duran, what do you make of this volatility this week? What's going on and what are you doing about it here?
Well, I think a couple of things. What you're seeing is the market is reflecting the stealth correction that's been happening for about 6 weeks now. The Russell it's down almost 10%. Many stocks down 20% or more. The indexes have done very, very well. So all that we've seen this week is the market reflecting that. And what we think is happening is a concern about the end of easy money, the beginning of higher interest rates. It's causing the dollar to go higher in anticipation, and especially relative to the euro. And the stock market's reflecting that. So more volatile, especially for companies that have less flexibility with their financial structure, and that's why the small caps have been lagging.
Are you going to buy the small caps here, Joe? Do you think that's it, that they've had their move? We haven't had a new closing high for that index since, what, July?
No, I don't think so, because even at these valuations, we're relative to the S&P at quite extreme levels, even with the stealth decline we've had, so no.
Ken Mahoney, you've been calling for an uptick in volatility anyway. What does this mean to you right now?
You know, since the beginning of the year, we've been calling for a choppy market, but with an upward bias. But now we're starting to see some headwinds here, like your first guest said. And, you know, we have kind of a stealth correction going on, whereby the major averages are kind of holding on to year highs. And yet underneath it, we've seen deterioration in the advanced decline line. We've seen the small cap taking on the chin. For us, though, the fundamentals in Europe really concern us. We start seeing the economies over there continue to slow down. And, you know, the policymakers keep getting further and further behind the curve. Yeah. And Russia still is a wild card. So we're going to continue to be consistent. We've recently sold the RIP incrementally, and now we're preparing ourselves to buy the next dip in this market.
Buying the next dip. Okay, Kevin, so we've now had both Joe and Ken talking about a stealth correction. I guess there are people out there who still think, is this going to morph into an event that pulls one of the major indexes down 10%?
Yeah, I wouldn't be surprised to see a bit more of a correction, only because we have had such a good run of it. The data has been incredibly good as it relates to the economy. We got a 4.6% print on third quarter GDP. Second half looks like about 3%. That's all the good news. The question is, the elephant in the room is interest rates. You've had interest rates at very low levels, negative interest rates for now 5 or 6 years. You've had a moonshot in equity prices for the last several years. Multiples are about 10% above where they ought to be, but that's reflecting improvement in the economy. So the real question is, what does the Fed do next? Is it time to start to normalize interest rates? Currency markets are picking up on it, and inflation expectations are falling. All of this is part and parcel of an adjustment to an economy that's getting better. So maybe some choppiness. This is not to be unexpected, and actually it's healthy to have a market that has some pricing discipline.
By the way, I noted when we showed the European markets there that the DAX, Germany, I mean, that's been the weakest market among the European majors. It fell below its 200-day moving average earlier this week, and it continued lower even as some of the others bounced at this juncture. Monica Meda, what are you doing with your clients' money right now as we see this volatility pick up here?
Look, you know, we're mostly in alternatives. We're doing a lot in real estate. We're in very geographic specific plays. So this volatility doesn't really change our strategy.
Is that a specific strategy right now, or is that where you actually see the better opportunity?
I think investing in what you know should be everyone's specific strategy. And so we're focusing on real estate in Texas, where you're seeing a lot of employment strength and a lot of people moving down here. But again, you know, one of your guests mentioned that one of the high points now is, you know, this higher GDP that we saw for second quarter. But I would argue that as a metric of economic vitality, you should really look into the details of what's driving GDP right now. You have a new definition of corporate profits, and you're actually seeing more spending for Obamacare that's required, but at the same token, personal spending and consumption still remains 20% below expectations. So that key metric of what calls for a strong, healthy economy is wages, and we still see very depressed wages, 8% below recession levels. So, I mean, I think you're very hard-pressed to say that we have a strong, healthy, vibrant consumer.
Okay, so now as we see the 10-year interest rate creeping back up a little bit today, is that because, Rick Santelli, the U.S. growth outlook looks a little bit better? Or is it a Bill Gross effect in the market here at all, do you think?
or is it that the stock market is only down 150 on the Dow where it sits and the S&P's only down 15? Many wouldn't have guessed that yesterday. You know, remember our conversation yesterday. I think the bond market divined something in a very excellent fashion. I think the lack of any major buying pushing 10-year rates dramatically under 250, the type of dynamics we saw in the first 6 weeks of 2014 when the equities couldn't get their legs together, didn't see it. So I think we're just going to have a lot more of the same. And I think, yes, there was some knee-jerk reaction on the, you know, everything gets speculated and arbed on what happened with Mr. Gross. Will there be outflows that we need to deal with? They had lots of futures positions. It's very liquid. I don't know that that's going to be an issue for the markets. But, you know, generalized weakness is the new fundamental to pay attention to, whether it's China and Europe. And those are slow-moving events. Don't see that they're going to totally destabilize what's going on in equities, and I don't think you're going to see any major moonshots on interest rates, but I think we should learn a lesson from yesterday that if the equities kind of still maintain very close to contract high pricing structure, I also doubt if we're going to get any significant tests of 2.25 as well.
Joe Duran, are you more inclined to want to buy the dips that we're seeing right now or sell the strength that we've been seeing lately as well in this volatility?
So I think neither. I think what you want to do is look at your personal portfolio. We manage our clients' entire net worth, and they have no good alternative. So what you want to do is within the portfolio and tilt it to the direction you should be. We think you want to be in larger cap names. Instead of dividend payers, you want to go to dividend growers. You have to figure out in advance, because the market acts in advance, what should you be doing in a higher interest rate environment and making those shifts now, because before interest rates go up, those stocks are the ones that will be already have gone up. So again, shifting from just dividends to dividend growers, focusing on larger cap rather than smaller cap, tilting away from emerging markets. You want to be very forward-leaning. Europe is going to get a lot of money pumped into it, and you've got to expect higher volatility.
Go ahead.
So one thing that we're looking at is kind of a hybrid strategy. Everybody has a philosophy how to handle this markets, but a hybrid strategy of using both buy and hold and being active. You know, 2/3 to 3/4 of your portfolio. If it's stocks or ETFs you like, you know, you kind of buy and hold that. But be a little bit more active with 1/4 to 1/3 of your portfolio. And what you want to do there is be able to buy the dips and sell the rips. Not day trading, but kind of have a combination buy and hold. Be a little bit more active when you see those dips and be able to sell those rips. And I think that'll give you better performance in these choppy markets.
Kevin, just a quick one to you, because I feel like we're talking about two different things here. Sometimes we've got Joe on the one hand and others talking about positioning for a higher rate environment, while at the same time Rick's saying the thing to watch for here is generalized slowing growth. And Monica too was pointing out that the economy may be weaker than it appears. So Kevin, is that what do you do with those conflicting stories? It seems as though investors are making two decisions that point in very different directions here.
Yeah, I think it's a couple different things. If you have a bond portfolio, we like the idea of laddering it. We do think there's a place for cash in portfolios if valuations don't make sense. And ultimately, if you look out 3 to 5 years, you're going to get a very different sense as to relative to what happened this week. And as a matter of fact, as far as the correction and volatility this week is concerned, it's really nothing, because we're looking at an S&P at 2,000. Equity values, U.S. equities are valued at something like $23 trillion. So we didn't move all that much this week. Just stick to your knitting, focus on cash-rich companies, consistently growing, reasonable price. You shouldn't do too badly.
Kelly, I would add one thing. I think you want to be looking at correlation getting decoupled again. Europe is in a very different place. Their banks are going to act differently than the U.S. in the future.
Let me just say, since you mentioned that, Joe, we're going to be asking our viewers a little bit later which section they would rather buy of the world, U.S. or Europe. A show of hands here. How many would buy Europe right now? Anyone? Okay, Joe, go ahead.
I just think you want to go where the market isn't. And they're going to have a lot of easy money for a very long time with lower rates than the U.S. a year from now. And their recovery, they are 18 months behind us. Would you have bought the U.S. 18 to 24 months ago? Yes. Do they have more risk? Yes, and their market has reflected it. You don't want to go where all the money has been made. So you want to be concentrated in the U.S., but you should be looking at Europe now.
Fair point.
Very good. Thank you all. Nice to see you. Thanks for joining us today.
Happy Friday.
Appreciate it.
Yeah, we got about 50 minutes to go here. We're going to pick